Hello, and thank you again for joining us. My name is Mike Menninger, and I am the host of Financial Planning Explained. I'm a certified financial planner and also the founder of Menninger and Associates Financial Planning. Here we are on week 2 with Sarinia Feinman, who is a family law attorney of Vetrano and Feinman in Pennsylvania. And one thing I didn't ask last time, and I just realized when we were chatting before this week's episode, is tell me a little bit more about your firm. Is it just the 3 of you, or do you have multiple attorneys? How many attorneys are over there?
So we're what you would call a boutique family law firm. So everybody in our office does family law. There's myself and my 2 partners who are husband and wife. That's the Vetrano and Vetrano.
Oh, that's Mr. and Mrs. Vetrano.
Mr. and Mrs. Vetrano. Now,
Okay.
Mr. Vetrano, he does civil appeals. He's the only one that doesn't do family. So people will hire him to do their appellate work in any type of civil case. So he doesn't do criminal appeals, he just does civil. But he is the only one that does that. And the rest of us, so we have, at present, we have 2 other attorneys in the office. We're hiring one now, but we have right now 4 of us that are doing family law with the hope of a
And you
5th.
do only family law?
Only family law. And in
family
family law, that's divorce. And that's with divorce is, equitable distribution.
Right.
That's the division of the marital estate. Alimony.
Right.
There's child support if there's children, custody of the children. Right. And then that also could be prenuptial agreements. I always say that's the happy part of what we do. And there's protection from abuse actions, and that's the complete opposite of a prenuptial agreement, the least happy part of what you might do in family law. And there's also can be a lot of post-divorce issues that might come up as well. So that's really the gamut of family law. It does not include wills and estates. And people always think
Thank you for
that.
bringing that. Well, yeah, So post-divorce issues. Mm-hmm. The only post-divorce issue that I can think of that would require going back to the courts is if it's amidst alimony that is based upon one of the 2 incomes, and that changes dramatically, and therefore they readjust the alimony. What other potential post-divorce issues are there?
And that's if you make in your property settlement agreement the alimony modifiable, because a lot of agreements you'll make them non-modifiable. So that is an option. If the court orders alimony, it must be modifiable under the law. But the parties all the time, and my general rule of thumb with parties is, and regardless of which side I'm representing, to be truthful, if the alimony duration is going to be 3 years, 4 at most, I generally will say make it non-modifiable.
Right.
Simply because you could be coming back every year. You'll spend your alimony to argue about alimony.
I know, it's silly.
And you've spent so much money to negotiate the deal.
Sure.
And so factor that in your mind that whatever this number is what it is. I'm going to get this or I'm going to pay this, depending on which side of the coin you're on, for the 3 or 4 years. If you start exceeding that, that's where you start having to include provisions for modifiability. And because no one has a crystal ball, right? If I had a crystal ball, I probably wouldn't be doing family law. But
I wish I had a crystal ball. Believe me, I wish I had a crystal ball.
There's a lot of things I would be doing. But so we don't have a crystal ball. We don't know in those moments if that individual who's paying alimony, who's making $300,000 a year, could get laid off tomorrow. Could be in an industry, and then we could be in a global pandemic. And then
what's a global pandemic? I've never heard of that before. What are the odds of that happening?
What are the odds? Exactly.
Yeah, once every 100 years or so, maybe?
Exactly. So you can imagine that has generated a lot
of course.
Issues as well.
Well, it creates uncertainty.
It creates uncertainty. So I think the further out you get and the longer the duration is, because I can always say to my client, look, even if you were to get laid off and you agreed it was non-modifiable and you're locked in, but you only have 1 year left, you can pull it from assets. No, that's not ideal.
Right.
But at the same time, if you had 6 years left on it,
well, of course,
you
that's
could be
different.
Homeless by the time you get done with your alimony obligation. So those are that is, yes, an obvious post-divorce issue.
Well, I would imagine it's also somewhat negotiable in the whole division is modifiable or non-modifiable.
Absolutely.
But what else could there be?
So there could be enforcement. So you spend all this money and time and energy coming up with your property settlement agreement.
Oh, and they're not paying.
And then something is not being fulfilled.
Right, okay, I
Or
gotcha.
there's an interpretation issue. Okay, I have an interesting one right now, and we're calling this, the other lawyer and I were calling this the ring case, because there's a provision in the property settlement agreement, and myself and the other attorney were not involved in that agreement at the time, and the provision provides for the husband to get the ring back, which doesn't normally happen, but it was a family heirloom.
Right, okay.
And he was, so he's getting the ring back. And then the wife is going to be entitled to, or she is entitled to, a replica of the ring.
Okay.
At husband's expense.
Okay.
So I didn't draft this agreement. Had I drafted the agreement, I would define replica.
Yeah, right. Okay.
Right. So you get
25-cent gumball machine. That looks close.
So what's a replica? You know, if I say I want a replica of the Eiffel Tower, that means you're not going to build me the Eiffel Tower.
Right, exactly. I got you.
Maybe not. Maybe you're building me the Eiffel Tower. Or maybe you're building me a little model that's like this.
Good point.
So those are the types of things that can come up because, you know, of course, the husband is going to say one thing and the wife's going to say another thing and say, this is what I was intending when I signed this. And if it wasn't defined, and now we're at a situation where one's, you know, I represent the husband, and he's saying, well, it was going to be like with a cubic zirconia in it.
Right.
And I'm gonna, you know, and that's gonna, and I checked with the jeweler, and it's $1,000 to make. And the wife says, no. I checked, I priced it out with jewelers, and the exact copy of the ring could cost me like $30,000.
Yeah, right. Exactly.
So, I mean, luckily, and this is a perfect example of the lawyer that you select in this process. The lawyer on the other side's a phenomenal lawyer to work with. And we are both lawyers. We've had many cases together, and we think outside the box, and we try to find solutions. These people have 3 children. They do not want to have to go to court and sling mud and get into you know, a battle over this, because guess what? They have to work together on a daily basis.
Not to mention that what happens, and I've seen this a lot, is that one parent can influence the kids because they're angry at because of the
ring.
Divorce settlement, whatever, exactly.
The ring issue.
Exactly.
Right. So, you know, that's an example. I would say there's no two, you know, post-divorce issues that are alike, because, you know, sometimes it can be, you know, obviously rooted in the agreement. I've had ones before where, you know, the agreement did not safeguard for someone becoming disabled, and the husband had an alimony obligation to pay that went on into perpetuity. Again, not an agreement, an agreement I drafted. It was actually until the wife sold the marital home, but there was no requirement for her to sell it at a certain point. So she never sold it, and she just kept refinancing it and taking money out. That wasn't the goal. But again, that wasn't the language in the agreement. And the courts are bound by the language in the agreement.
Of course.
And that now that individual who had been paying the alimony was now completely disabled and unable to work, and had an alimony obligation.
Right.
And so that was another, you know, now coming to the court saying, well, he can't perform on this contract. This is an, you know, an impossibility to perform. That actually went all the way up to the Superior Court on an appeal, and then ended up, the parties, after all that money and all that time and energy, did reach a resolution that included the alimony terminating, you know, and the wife had gotten a lot in that case through the years. But, you know, these are some of the types of issues that can come up post-divorce that, you know, you didn't necessarily plan for. I think, you know, and of course I'll pat myself on the back on my property settlement agreements to think, you know, 4 and 5 and 6 steps ahead.
Well, of course.
Because the goal of the property settlement agreement should be that this is your roadmap. These are your list of rules. This is what you follow. If this happens, then we do this. Well, if that happens, then we do that. That's why typically, like with the house is a big one. You know, a lot of people think, well, we can't have a property settlement agreement until we sell the house, or until, well, that's not true. We just have to put the language in the agreement that specifically says, okay, the house is on the market at the time of execution of this agreement. This is what we're going to do. You know, and this is what we're going to do in terms of accepting offers, or in terms of relisting with this agent, or at what price, and if the parties can't agree, this is what we're going to do, and if the house can't be sold, this is what we're going to reduce it by, or we're not. If we are in agreement to get a new realtor, or we're not. So we do have to deal with a lot of those things. There's also, you know, provisions where someone's going to refinance and they have a period of time to do so, and there might be then contingency language. If they can't do so in that prescribed amount of time, then they have to list it for sale. And these are all that we put all that language in. So you're remiss if you don't include that. And many, many years ago, when everybody and anybody could get a mortgage, because you didn't have to, you could provide you could just provide a blank piece of paper and say, here you go, you got a mortgage, you get a mortgage, you get a mortgage, you get a mortgage, you all get a mortgage.
That's right.
So that was, and there was a period of time many years ago. So in those property settlement agreements, they didn't address those kinds of things because they didn't need to. Everyone was going to be able to refi.
But things have changed.
But then when things changed, and this is going back some years at this point, but you need to have that contingency. So, those of us that obviously do this routinely and do this regularly know that we need to include those contingencies.
Yeah, you gotta build a strong agreement that's ironclad but also flexible. I'd like to pick up where we left off last week. Tax law changes as it pertained to alimony was at the end of 2019, I believe, maybe 18. That made it so that it was no longer tax deductible to, I'll call it the donor, and therefore tax-free to the recipient. Now, if I was making a massive alimony payment, I will tell you that I honestly think it's not fair that it's not tax deductible because it's pulling right from my income. But let's say, for instance, I had a $5,000 a month alimony payment, or that's what it would have been. When they've changed the laws, did they adjust it to say, well, gee, you know what? You would have gotten it as tax deductible. It's not tax deductible anymore. And then they kind of figure out what the tax impact would have been?
So here's what happened. It was actually a very interesting time. So I don't know if you recall the exact timing of this, but once they affirmed that, we knew it was kind of in the works, that this was going to happen, but they dropped the ball at the end of 18 to say, the other shoe dropped and said, these are taking effect January 1 of 19.
Right.
Real quick.
Everybody's trying to get
in the family law, in the rules, and in our divorce code, those had to be revised and updated, i.e. the support guidelines, because during the time when you're separated but not divorced, we're doing support based on the Pennsylvania Child Support Guidelines and the guidelines that pertain to spousal support and alimony pendente lite, APL for short. Now, prior to the tax changes, the spousal support APL number was 40% of the difference between parties' net monthly incomes. And it would be 30% if there was child support involved, and the child support would get deducted. And it was very clear cut. That's what it was.
Understood.
And then from that, you're right, that the spouse receiving it had to pay tax on the alimony portion, not child support, never child support.
Aware of that.
And then the payor would get to deduct it from his or her income. Now, post January 1, 19, they had to get these new guidelines out, and now the guidelines are totally changed to adjust for that.
Okay, question for you, though.
Is it perfect? No.
But if I got divorced in 2017 and I was given $5,000 a month, is it that it was deductible in 17 and 18 was no longer deductible, or I was grandfathered in?
If you had a signed property settlement agreement that was signed December 31st, 2018 or prior, you get to include it or deduct it from your income, and they have to still add it to their income.
Okay, so in other words,
so you don't lose out on that and still paying the higher number.
Right. Oh my gosh, that would be brutal.
That would be brutal. Now, if you are signing an agreement or being, given an order from the court post December 31st of 2018, it's going to be under new guidelines, and you're not going to be able to deduct it or include it any longer.
Right.
And so there's, there was protection against that, and they did adjust that to reflect, specifically the new tax changes at that point.
Right. I would have been really angry if I was pre and then they flipped it and I couldn't get the deduction anymore. That wouldn't be fair unless they went ahead and made adjustments to it, because generally speaking, the person who's paying the alimony is in all likely a higher income, which means that they could use the tax deductions, paying to the lower income who it doesn't hurt as bad getting the tax. So you flip that switch on me,
What we had at that time, which made some cases, maybe they were on the verge of settling. So at that point in time, we had a bunch of cases that if they were on the verge of settling, there was incentive sometimes to get that done by that December 31st, 2018.
No kidding.
But there was a lot of cases where they were paying interim support while the divorce is pending. Now, fast forward, you're now in 2019 or 2020, and you're reaching your full property settlement agreement. You're redoing all of those numbers.
Yeah, you have to.
And the alimony, because now you're not going to be able to say, well, I'm going to rely on my support order, on my interim support.
Sure.
It's not going to
well,
work
I
now,
remember back
so,
in that year, it's
yeah.
like, depending on which side of the table you're on, if you're the recipient, man, well, I'm going to kick this thing down until next year. And if you're the donor, you're like, let's hurry up and get this thing done. We're up against break. We're going to take a commercial break from it. What I'd like to do is pick up on topics associated with the division of assets. You call it equitable distribution. So come join us. Please stay tuned. Thank you for joining us. We'll be back in a moment. All right. So
Top 50 in the nation.
Basically, we earn more and pay less.
RCBC students are accepted at Rowan University after graduation.
And get a bachelor's degree for around $30,000.
Online and Mount Laurel students get a 15% Rowan University tuition discount.
And have many scholarship opportunities.
So you earn more and pay even less.
Rowan College of Burlington County.
Your path to success.
They are the greatest fighting force the world has ever seen. But what does it take to strengthen our service members? What does it take to let them know that we stand behind them, wherever they are? What does it take to bridge the distance and keep them connected to family, home, and country? And what does it take to prepare them for their future when their service to the nation is complete? What does it take to strengthen our service members so they can be the greatest force for good in the world? It takes a force. Be a force behind the forces. Share a message today at force.uso.org.
I want to be a contender. I want a warm belly to sleep on.
A big house.
How do I look? Do I look good?
I want to play hard.
My nails done once a month.
I want
I want a home.
I just want a home. I want someone to love.
Last year, more than 30,000 companion animals came to us without homes. 20,000 of them were felines. Let's make some homes together.
welcome back to Financial Planning Explained with my special guest, Sarinia Feinman. Now it's time, as we hit the home stretch, to talk about the financial piece of it. Okay, and the financial piece really takes into consideration three things. We spent some time on alimony, which, you know, as you had pointed out, certainly in Pennsylvania, is, and I've seen it before, it's semi-cut and dry because there's percentages of one income, percentages of other income. I also saw that child support, when I went through it, was based upon, again, percentage of income and number of children. Division of assets takes on a whole new breed.
So let me just respond to in terms of it being straightforward or with the support. Too many people think that it is so straightforward, and I'll get a lot of cases where they thought, well, I'm going to go, to the conference myself, or I'm going to, go to the master myself. And then it goes south, and then they hire me and they want me to clean up the mess, right? and that is because that's, the earlier levels are the more informal levels. And so those are the cheaper levels to be able to reach agreements. Mm-hmm. And so, while the guidelines are straightforward in the sense of, getting to the bottom line number, where you start and how you apply to get to that bottom number is where the arguments come in. In terms of the earnings and the earning capacities, in terms of how you're, the child tax credits and the tax filing statuses and things like that.
More to
it. So that isn't, and so if you wait and you say, like, well, I can do this myself because the court's just going to run the numbers and it's boop, 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 and here's what it is. You're not necessarily, that's not necessarily
I speak from
accurate.
Experience, and you know why? Because I was self-employed. And it was amazing, and my attorney actually had to hold me down a couple times because I couldn't believe when they said, well, just use your total income as opposed to your profit. And I'm like, you mean my business expenses don't count against my business income?
Well, they do.
I know,
They
but
do.
Oh, believe me, that was the argument.
And there are certain expenses, the most obvious one that everyone, knows that gets added right back is like a depreciation expense.
Of course.
That's
Of
not
course,
an
because
actual
it's not an actual expense.
Nobody
That's
comes
correct.
at the depreciation police and comes and collects your
Oh, I know,
money.
but you know what? My rent and my employees
That's real
didn't count.
expenses. No, those get
I could not
deducted.
believe
those
that.
get deducted. And then in the alimony, just to, alimony post-divorce versus the spousal support while a divorce is pending. Technically speaking, and we've talked about the factors, the alimony factors post-divorce get applied. And so someone who is seeking alimony in the overall deal, they are under an obligation to establish a need for it. So that's the arena where we're going to say in equitable distribution, we need to see your expense statement.
All right,
Because
I've seen that.
do you really demonstrate
Do you
a
warrant?
need
Right, I got you.
for alimony at all, or alimony at a certain level? And just because the guidelines provide for your alimony figure would be $4,000 a month, if you only show a need over and above your income for $3,000 a month, then that's going to be your alimony number.
Right.
And then on the flip side, if you demonstrate a need higher than the number, the court could go higher. They generally don't, but they could, depending on other things. So it could be that that's really not a 50-50 case, but they're going to agree to a 50-50 split because we're going to go higher on the alimony. Longer
I got
duration.
a question for you. Just thought about it as you were talking about it. I like to call it, in the sort of criminal law system, okay? Time served.
Time served.
So let's say, for instance, you're using the guideline of been married for 15 years, I owe alimony for one out of every 3, I owe for 5 years. If I am paying the spousal support for 2 years from the time of separation to the time of divorce, is it going to be 5 more years, or is that time served?
Well, it could be 5 more years because you don't necessarily get time served. And it depends on the amount of time served. So, I had a case recently where the time frame from separation to divorce was 6 years.
Yeah.
On a 12-year marriage. So a 12-year marriage with a 6-year separation, they were separated for half the time that the marriage was so at that point in time, yes, that my client got some credit, we'll say, for time served because, it was an extraordinary time.
Right.
But if you're only paying that for a year, maybe 2 years, the notion behind the support while the divorce is pending is to be able to afford the divorce. And that's how the court gets out of saying that was for your alimony, which you need as your income stream forward, because you needed that so that the payor goes out and gets a lawyer that costs a lot of money. Meanwhile, the person who's receiving the alimony, who maybe isn't even working or making $30,000 a year, they'd have to represent themselves.
Right, I gotcha.
So that's to afford the divorce. So you don't necessarily get that time served. And that sometimes is a reason where if you do want to be divorced and you're trying to push it forward, you might sweeten the pot and say, okay, well, I'm going to offer a little more, or I'm going to not seek any credit for that and just pay you the 4 years or the 5 years from now forward, and to bring it, it to a close. So
I could see all the reasons for
there's all those
negotiation.
things. But to go back to your equitable distribution question,
Yes,
getting into
because we're running low on time here.
So to go back to that, a lot of people come in and they believe that, okay, if this is going to be, and I'll use the example of a 50-50 case, right? So, okay, that means we're going to take each and everything in the marital estate, we're going to divide it 50-50. And I go, no, that's going to create a nightmare. Because if I have a bank account that has $10,000 in it, and you have a bank account that has $8,000 in it, I'm going to give you 5 and you're going to give me 4. That doesn't make any sense, right?
Just give me 1.
So, right. So at the end of the day, what the court looks at, which is what the lawyers are guided by, is to look at different types of assets. So nobody's going to generally walk away with all of the retirement accounts, while somebody walks away with all the cash or assets that have a liquid base.
Okay, the thing is, you're talking about 2 different things, and I'm glad you brought that up, because, like you said, when you got retirement assets, the one spouse who makes a lot of money and will likely potentially have a pension, those retirement assets, I could see negotiating to give a lot of those taxable retirement assets to the spouse, because you're going to have a difference in income tax brackets in retirement, where I think you can really proactively negotiate something even better. And what do you do then if you have an illiquid asset? And an illiquid asset more commonly may be the house, and we talked about this, where the one spouse has a $300,000 IRA, the other, and then there's the $300,000 house that's paid off, and there's no liquid assets.
So in that, I mean, let me, the courts really do look at the house in that liquid because it can be sold and converted to cash. There can be a refinance and cash taken out. So they lump that into, you got your bank accounts, you've got life insurance policies that have cash value, you've got the house, you've got, so in those cases, for example, if you have, and let's put the retirement on the shelf for a minute, between the house and the bank accounts and the cars and all the other things that could be sold and converted to cash without a tax consequence, okay? So when you have all of those things, if those all total $1 million, but the house itself is 500, and the wife says, well, I'm keeping the house, then maybe the husband's going to get all the other stuff.
Right.
If it's going to be a 50, in a 50-50 split, and then that's how they're going to, we're not going to say, well, you have to refinance the house, wife, and you've got to take half the equity. Well, then she's going to say, I can't afford to keep the house if I have to take half the equity out and pay him.
Right, and not only that, but she may not be able to, for whether it be credit reasons, income reasons, she may not be able to refinance the house. And I've seen that before.
In that scenario, she keeps it, and then he's getting his half, let's say, of the equity in the home by way of getting other assets that are of the liquid nature.
I gotcha.
Now, then you've got the retirement, and then we're going to try to, strive to do 50-50 on that. There could be 6 retirement accounts. Again, we're not going to do 50-50 of each one. We're going to add them all up, and we're going to, figure out, and then we're going to do, hopefully one qualified domestic relations order, which is the mechanism by which you transfer the retirement funds from one spouse basically to the other as a rollover
Question
into an
on
IRA.
that. That's a quadro, QDRO.
Yep, quadro, yes.
Is a quadro only applicable to like pensions and 401ks, or is a quadro also applicable to a traditional IRA?
So I will tell you, it depends on the company. And I will tell, because in the quadros, I've had IRAs where they required a quadro, and so I definitely had it. But I will say I've had cases where if there's already existing IRAs and it's the same company, and we'll just say Fidelity, and they each have a Fidelity IRA, and we're just rolling over funds. A lot of times they'll have a form that can be done, and
Except for one thing,
you don't always need it. So in my agreements, I'll make sure to put the language on both sides.
The reason why I asked that question is because quadro also affords the recipient the opportunity, is it 30 or 60 days, to be able to access the money prior to age 59 and a half without paying a 10% penalty.
So under IRS Regulation 72T, they can do that.
Right.
And they can avoid, like exactly what you're saying, the taxes and the penalty, not
just
the taxes.
The penalty.
The penalties and the interest. They can avoid the penalties and interest. They won't avoid the taxes, but they'll never avoid the taxes.
Right, of course not.
None of us are going to avoid the taxes. So they can do that, and it's one time only. And so if, again, that might be a way in an estate like you're saying where there is no cash, and we've just got the IRA, we've just got the house. So that could be a scenario where we are saying, okay, we've got the retirement account, and we're going to roll over a piece to the other spouse, and because they need some cash, they're going to take it in the form of,
So it doesn't have to be the quadro. And last but not least, what do we do if it's an illiquid asset? And what I mean by that,
I just want to go back one thing. The 72T will only apply to a 401k. That does not apply to an IRA.
Okay.
Just so.
Okay. Yeah. What about illiquid asset? I own a business. My business is worth $1 million, but and there's really no other assets. And you find this a lot. And I see this with clients that they put all their heart and soul, and every extra dollar goes into the business, or they're making nothing because all of it is into building the business. How do you split up a business?
So those are the cases where you hope that there's a house and maybe a vacation home, because then, one person can keep their business and the other one can get the house and the vacation home, and sometimes that's going to, wrap it up nicely. That obviously is not what happens in most cases. When there's a marital value to the business, and we're getting business valuations to determine what the value of the business is, separate and apart from the income. Because in Pennsylvania, you can't double dip. So if something is considered income, it's income. If it's considered part of the value of the business, it's the part of the value of the business. But it can't be both. Can't be counted twice.
Okay.
So there are certain businesses that I would say, and I don't want to say we know those, but where there's a kind of a business where the value isn't a value. There is no value to the business because it's discounted all the way down to nothing based on personal goodwill and other reasons.
Well, of course.
But it's all income. But it's income.
Right.
So then for support purposes, we're using that, but we're not, there's no value to the business.
Right,
But
okay.
if there is a true business and there's equipment in the business that has value and there is a business where you could sell that to me, then and if there are some discounts for personal goodwill, then that would be, done by the business valuator. In some of those cases, the lawyers will have to decide, do they want to get one business valuator that's a joint valuation, or do they want to get competing business valuations?
And by the way, business valuations aren't cheap.
They are not cheap. They are not. They can be $5,000 to $15,000.
I know it. That's...
And then when you want them to come in and testify, a lot of times, it can create a bigger issue where you have competing valuations and they're so far apart, it's not one of those scenarios where you can say, hey, let's split the difference.
Yeah, right.
It's way too far of a difference.
Absolutely. That's when you're going to have battles.
And so that can be really difficult. Now, with the business itself, a lot of times what ends up getting, in the overall settlement, what happens is in order to give the spouse who's it's not their business, their share of it, if they can't get it between and betwixt other assets in the marital estate because it's just not large enough, they're going to have to get what they're supposed to get from that business in equitable distribution payments over time.
Right. I can see that.
And people don't like to hear that, and they want to say, well, what if the business goes belly up? What am I supposed to do? Now I've got a piece of paper. It's one of my post-divorce issues again, and I'm coming back.
There you go.
And then the business owner says,
well,
there was a global pandemic, and I was selling something that now is obsolete. So now what do you want me to do?
I know. That's tough. Well, believe it or not, we're out of time. This has been, we could have done a third week of episodes because, you talk about that because then there's valuation at date of marriage, valuation at date of separation, and there's so many different things, particularly if the business owner owned the business for 10 years prior to coming into the marriage and oh my gosh, there's so many different things. But thank you very much. There's very informative, lots of good stuff. You and I can go at this for hours. But we don't have hours.
Thank you for having me, Mike.
It was absolutely my pleasure. So I wanted to take this into, we all know somebody who's gotten divorced. And unfortunately, in today's day and age, the statistics are pretty bad, 50%. One of the things is it's extremely important how much it ties into financial planning, because when someone is about to receive a equitable distribution or alimony or whatever it may be, it is so important for both parties to really evaluate the impact. And so when you're doing retirement planning, if there's someone who's 55 or 60 years old and they're about ready to receive, they ask me, Mike, can I live on this? Okay, how much can I live on? And it's important to evaluate all those things. They probably had to do for the divorce, how much money do I need to live on? What are my expenses? But then we have to project forward, Social Security. We have to project, are you selling the house? What's going to happen? Are there college costs that are going to be involved? And one concern that I've seen all too many times is that the recipient of half of the assets doesn't properly plan. And all of a sudden they spend a lot of the money and then they're left in a position 3 to 5 years later where they don't know what to do. And so I can't begin to tell you how important it is. Here I am, of course, I'm going to say financial planning is important because it is. And so from both sides. And oh, by the way, you really need to understand the tax implications associated with the receipt. Oh, great, I got a quadro. Let me just take the $200,000 and pay off the house. Meanwhile, Uncle Sam shows up on their doorstep, so to speak, April 15th of the following year. So believe me when I tell you, as much as I hate divorce, and I've said it 100 times, it's very, very important for planning. And again, I appreciate Sarinia coming on. I didn't even give you a chance. Please tell the camera, how can someone get a hold of you? I love the way you operate as a family law attorney.
Thank you, Mike. And I'll say this. although I advocate for those that are going through divorce and help them through what is a very difficult process, I myself don't necessarily advocate for divorce. These people have concluded that that is where they want to go. In fact, I have had those rare clients that have come to me and I've said, you're not sure about this. Let me give you the name of a counselor, a marriage counselor, and if you still want to do this, come on back. So I can be reached Vetrano and Feinman in King of Prussia, Pennsylvania, and my number is 610-265-4441, and you can Google me, and my email is out there as well, and I believe it is posted right below as well.
Excellent, excellent. Well, thank you very much.
Thank you, Mike.
Thank you for joining us, and I hope you have a terrific week. And you can always go through me to find Sarinia. Again, thank you for coming to my show, Financial Planning Explained, and I am your host, Mike Menninger, Certified Financial Planner. Have a great week.